Welcome to the latest Motley Fool scoreboard. I'm Anand Chakavalu, and we've got longtime fools Anthony Chavone and Matt Argersinger giving a 1 to 10 rating to the Sunbelt area focused industrial REIT that I may or may not have thought made backpacks. It's EastGroup Properties, ticker symbol EGP. As always, we'll rate EastGroup Properties' business, its management, and its financials. We'll talk valuation. And if there's time, fools, we'll play Armchair CEO, and we will top it all in about 12 minutes or less, maybe even shorter. So let's get to it. Matt, how do you rate the strength of EastGroup's business, including factors like its industry and its competition? Scale of 1 to 10, 10 is invincible, 1 is hopeless.
Well, Anand, I'm going with 8, pretty high for EastGroup Properties. As you mentioned, it's an industrial REIT. It is mostly focused on the Sunbelt. Most of its properties, almost all of its properties, are kind of shallow bay, distribution-oriented, think warehouses, logistics facilities, in what they call last-mile locations. So really strategic real estate that's important for 3 big trends that I'm going to talk about, which one being the obvious one is e-commerce. We are living in a more and more e-commerce world. More and more retail sales are being driven, of course, by online sales. That fits perfectly into EastGroup's strategy. The second big trend is, you said it, Sunbelt. They derive about 70% of their operating income from states like Texas, Florida, Arizona, North Carolina. These are among the fastest growing states in the country. It's where a lot of people are moving to, a lot of businesses are going to. That's a big tailwind for them. And then post-COVID, we've seen this really need for companies to really optimize their supply chains, have higher inventory ratios, practice what they call just-in-case inventory management. God, that's another big, huge tailwind for EastGroup Properties. I would say the one reservation I have about EastGroup and why I don't give it a 9 or a 10 is they are among the smaller REITs. They are a large industrial REIT, but they're still less than a tenth of the size of Prologis, for example. It's still a highly fragmented market with lots of supply, and they're very development focused at EastGroup. So it's more capital intensive than maybe other REITs. So that's why I'm giving it 8 out of 10.
Yeah, I'll go with a 7 for EastGroup's business. Matt, you mentioned a lot of the major things, but another thing that I like about EastGroup is that about 50% of their portfolio has been developed internally. So I think that's really important because they can design the properties to their specifications. They can build them for the long term. And then the other thing that I like about them too is that they have the most diversified tenant base out of, I think, any industrial REIT. Their top 10 tenants account for just under 8% of their total annualized base rent. So I think that's really important. And then aside from the e-commerce and migration trends that you mentioned earlier, I just think industrial real estate is an advantage property type. If you think about a warehouse, right, it's just 4 walls, you have a ceiling, you have a roof. There's not a lot of recurring capital expenditures involved with maintaining a warehouse. And that allows more cash to ultimately be returned to shareholders. And I'll only give it a 7 because this business is a little bit reliant on outside forces that aren't necessarily within the company's control. So you think about like supply and demand fundamentals, the health of the economy, and migration trends as well, although those have been positive recently. But I'll settle with a 7.
Yeah, given its smaller size, that diversification, Ant, that you were talking about really gives me some comfort where it's not just reliant on, you won't want to see 32% is from this one big tech company. Let's move on to management, Matt. Scale of 1 to 10. 10 is Warren Buffett, of course, and 1 is Homer Simpson.
I might be a little high here, but I'm going 9 out of 10 on it. And that's because I'm just really impressed by CEO Marshall Loeb and what he's done. His tenure goes back to 1991 with EastGroup Properties. He was with the company for the first 10 years of his career. He went off to be an executive at a couple of other publicly traded REITs before rejoining EastGroup in 2015 and then becoming its CEO in January 2016. And since Loeb became CEO in January 2016, EastGroup has outperformed the S&P 500 by more than 80 percentage points. That's hard to do as a REIT, especially in recent years. Real estate has been in a pretty big bear market, yet EastGroup has continued to outperform and deliver amazing returns. And I'm going to steal a page from Ant's playbook here, but one of the great ways you can measure a REIT's management is how they've grown the dividend versus the rest of the company. EastGroup has grown its dividend by about a 13% annualized rate over the last 10 years. Over that same span, EastGroup shares outstanding and total debt outstanding have both increased at just around 5% annually. So the dividend growth is growing way ahead of those critical capital parts of the company, I think that's a really strong sign of management. So I'm very impressed here.
I'm also going to go high here at an 8. Matt, you mentioned Marshall Loeb, just been a tremendous CEO since he's been there. I also like looking at the proxy statement too for REITs, because at the end of the day, they're allocating capital, and that's what we need to focus on as REIT investors. And if you look at their compensation incentives, they're based on FFO per share, so per share metric, that's good, based on same property NOI growth, and then a couple of balance sheet metrics like debt to EBITDA and fixed charge coverage ratios, as well as total shareholder returns. So I think it's kind of rare for a REIT management team to be compensated on balance sheet metrics. So I think that's definitely a good sign. And then something unique about EastGroup's management team that you really don't see in any other REIT is that they don't have a chief investment officer. I find that fascinating. All the development, all the acquisition, all the disposition activity is decided by the local teams that are operating those assets. And I think that's good for talent development too. Like Marshall Loeb was in charge of that at one point in his career at EastGroup. So I just kind of like how that EastGroup has that decentralized culture. The only reason I give him an 8 is because of low insider ownership at only around 1.5% of shares outstanding. That tends to be fairly common for REITs just because of the way they're structured. So I'll go with an 8.
All right, financials, Matt. A 10 is a fortress, a 1 is yikes.
I'm dishing out another 9 here. I'm pretty so just quick financial snapshot of EastGroup. Looking at just their second quarter results, the most recent results. The operating portfolio was 97% occupied as of the end of June. Rental rates, new and renewing leases, up 60%. That's an incredible. Same property net income of 5%. Funds from operations, which is the key measure of a REIT's cash flow, that was up 8.5%. I can't recall a quarter going back many years where EastGroup has not shown growth in funds from operations per share. So the business is performing really well. And if you look at the balance sheet, you've got debt to total market cap of just 16.9%. Debt to EBITDA is less than 4x. Both of these metrics are very strong for REIT. And with interest rates headed lower now, EastGroup's balance sheet is only going to get de-risked, and their liquidity is only going to get higher. So I just think they're in a really great position financially.
Yeah, I'll go with an 8 for the financials. Matt, you mentioned the FFO per share growth, the earnings growth. That earnings growth has led to phenomenal dividend growth as well. EastGroup has paid a dividend for 179 consecutive quarters. They've also increased or maintained their dividend for 31 consecutive years, including increases in each of the last 13 years. So this is a steady dividend grower. You can see that cash that they generate flowing back to shareholders, which we love to see. In August, they increased their dividend by more than 10%. So that's a good sign. And over the last 10 years, they've grown their dividend by just about 150%. So really impressive there. And then, Matt, you mentioned the strong balance sheet too. Debt to EBITDA is at an all-time best for the company. Their debt to market cap below 20%. I mean, typically in the private real estate market, you'll typically see like loan to values closer to 60% or 70%. So this is a very, very well capitalized company. I only give them an 8 because of their size, which you mentioned earlier, Matt. They're a little bit smaller. They can't necessarily get the best terms, the best interest rates on new debt that they issue, like somebody like a Prologis can. So that's the only reason why I give them an 8, but definitely a strong company here.
You can tell how much they like the company because they're both kind of apologizing when they give like an 8. And let's talk valuation. How well will EastGroup's stock do over the next 5 years, and how safe is it? Keeping in mind a 10 is a sure thing, 1 is a lottery ticket.
Yeah, so over the last 5, 10, 15, and 20-year periods, EastGroup has delivered a compound annual total return north of 10%. So I'm going to go between 10 and 15% annualized over the next 5 years. Today, if you look at its dividend yield, it's got a yield of about 3%. It's growing its dividend at a 10% rate. So theoretically, that should produce a total return of around 13%. So I think that's reasonable. And then when you factor in the tailwinds of e-commerce, Sunbelt migration, some of the rent growth that's already embedded in its below market leases that it has within its portfolio, I think that's going to lead to at least double-digit returns from here.
I'm also going 10 to 15%. I'm a 7 in terms of my confidence with that. The valuation is a little high. If you look at what they're guiding for FFO per share this year, It's the stock right now is trading for around 22, 23 times that figure. That's a little high, even though I think EastGroup does deserve a premium. As Ant mentioned, dividend yield is right around 3%. You add that to the dividend growth or to the FFO per share growth. Easy to see double-digit returns here, but valuation's a little high, so I'm not super confident in it, but I'll give it a 7 for that.
And I should say, I don't think I mentioned, I'm also going with the 7 because of the valuation.
All right, we're going to skip Armchair CEO in the interest of time and go straight to everyone's favorite topic. I expect to hear Prologis somewhere in here. Anthony, is there a company in EastGroup Properties space that you like better?
Yeah, there's this company called Prologis. That's my topic. Just a massive company. I think it has a market cap of over $100 billion, but I still don't think the market fully grasps like just how strong this company really is with its management team, its balance sheet, just everything involved with the company. It's just phenomenal.
I got to say Prologis as well. And real estate size does make a huge difference for returns. And, as Ant mentioned earlier, access to the capital markets. And so, yeah, Prologis was the pick. I love EastGroup, and I own both EastGroup and Prologis. But if I had to pick one, I'd probably go to Prologis.
Well, thank you to both Matt and to Ant. And as you'd expect, because I had to buy Prologis on a prior episode of this, EastGroup didn't quite make it. They got to 7.8 out of 10, just short of that 8.0. But I think I speak for many of us who hadn't really studied or maybe even heard of EastGroup before, that it's on our radar now. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is Avalon Bay. Till then, Fool on. We're all getting a little older and crustier, except Ant. You'll see it, Ant.